In 48 hours, one man lost $20 billion. Not a company, one man. That's more than the GDP of Iceland, gone before the markets even closed on a Thursday. And the part nobody saw coming, he had done something like this before. This isn't just a story about one reckless trader. It's about the entire machine that let it happen, the banks that handed him $100 billion in buying power, the regulators who looked the other way, and the retail investors who got crushed when the walls came down. If you've ever been bullish on a stock and wondered what too much leverage actually looks like, this is it. This is the answer. So how does a man go from managing one of history's greatest fortunes to criminal indictment in under 72 hours? Bill Hwang wasn't an outsider. He was a disciple of Julian Robertson, the legendary hedge fund manager who ran Tiger Management and minted a generation of Tiger Cubs, traders who went on to run some of the best funds in the world. By the 2000s, Hwang was running Tiger Asia, his own fund. It grew to over $10 billion. Wall Street respected him. But in 2012, Tiger Asia pleaded guilty to insider trading charges, wire fraud, and trading on material non-public information about Chinese bank stocks. Hwang paid $44 million in civil penalties. The fund shut down. Most careers end there. His didn't. He converted Tiger Asia's assets into a family office called Archegos Capital Management. Family offices aren't required to register with the SEC the same way a public hedge fund is. Less paperwork, less scrutiny, more freedom. By early 2021, Hwang had quietly accumulated positions worth an estimated $100 billion, leveraged through instruments called total return swaps. These let him control enormous stock positions without technically owning the shares. The banks held the actual stock. Hwang just received the returns or the losses. Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, Deutsche Bank, all of them were his prime brokers, and none of them had the full picture. Each bank saw only their own slice of his exposure. Because these swap positions existed outside normal disclosure requirements, Hwang was making the same concentrated bets across multiple institutions simultaneously, a wheel of leverage so large that if even one position turned sharply against him, the whole structure would collapse. Here's what every one of those banks knew before they lent him the money. Hwang had a prior conviction for securities fraud. Here's what they chose not to share with each other, how much they had each extended him. The fees were too good. His positions were also dangerously concentrated. Viacom CBS, Discovery, GSX Tekadu, Baidu, several Chinese tech names. In some cases, he effectively controlled entire float percentages through his swap positions. That kind of concentration only works in one direction. In March 2021, Viacom CBS announced a routine stock offering. Dilutive. Shares dropped, then dropped more. Margin calls started. When a leveraged position moves against you, your prime broker demands more collateral. If you can't provide it, they liquidate the position to recover their exposure. On Friday, March 26, 2021, Archegos failed to meet its calls. The banks had a choice: move fast and contain the damage, or wait and negotiate. Goldman Sachs and Morgan Stanley moved fast. They began dumping Archegos' positions in massive block trades, billions in stock unloaded before the rest of the market understood what was happening. Credit Suisse hesitated. That single delay would cost them $5 billion. Viacom CBS lost 27% that Friday. Discovery fell 27%. GSX dropped 40%. Billions in market cap evaporated before the closing bell. Retail investors holding these stocks, people who had never heard of Archegos, who had no idea they were exposed to a shadow position worth hundreds of billions, watched their portfolios collapse with no explanation. By Monday, the full picture started emerging. Banks reported massive losses. Credit Suisse announced $7 billion write-down, later revised upward. Nomura disclosed $9 billion. Total bank losses across the industry, over $10 billion. But it gets worse. Bill Hwang's personal fortune was gone. At his peak, he had been worth an estimated $20 billion. In 48 hours, it ceased to exist. In April 2022, federal prosecutors indicted him on fraud and racketeering charges. The Justice Department alleged that he had manipulated stock prices, artificially inflating the value of his holdings to unlock more borrowing capacity, and had lied to banks about his positions and Archegos' actual risk. In July 2024, a federal jury convicted him on 10 counts of fraud, racketeering, and market manipulation. Prosecutors called it one of the most significant frauds in financial history. Credit Suisse never recovered. Between the Archegos hit and separate failures in its wealth management arm, the bank's reputation cratered. In March 2023, it collapsed entirely, absorbed by UBS in an emergency government-brokered deal. One of Europe's oldest financial institutions, undone in part by a family office's margin call. So what do we actually take away from the Archegos collapse? Lesson 1. Leverage amplifies in both directions, and concentration multiplies the risk. Hwang's positions were so large and so focused that a single routine stock announcement, a dilutive offering that happens hundreds of times a year, was enough to trigger a total cascade. Diversification isn't just advice. It's the difference between a bad week and a complete wipeout. Lesson 2. Past behavior is a preview. Every bank that extended Hwang hundreds of billions in credit knew he had pleaded guilty to securities fraud less than a decade earlier. They did it anyway because the fees were too good to pass up. If someone's track record contradicts what they're telling you, the track record wins. Every time. Lesson 3. What you can't see can still hurt you. Retail investors holding Viacom CBS had no exposure to Archegos until they did. Hidden leverage doesn't announce itself. The pain lands on people who never took the risk. The people who built Archegos weren't reckless in an obvious way. They were disciplined, connected, and extraordinarily good at what they did until the math stopped working. The difference between them and you isn't intelligence. It's knowing where the trapdoor is before you step on it. If today's story made you look differently at how much of your net worth sits in a single stock or sector, that's the right reaction. More than 20% of your portfolio in one name is the kind of concentration that has wiped people out repeatedly. Webull lets you see your full allocation clearly, track your positions in real time, and trade commission-free for 90 days when you open and fund an account. The link is in the description. And one more thing, if you've ever held a stock that got obliterated by someone else's margin call, or you've been on the wrong side of a leveraged bet you didn't fully understand, I want to hear what it actually cost you. Criminal behavior, or just reckless gambling that got out of hand? Tell me below. Save this one so you can come back to it. The next time someone pitches you a leveraged position, these 3 lessons are worth remembering. And if you want more breakdowns like this, the frauds, the collapses, the moments where everything unravels in real time, we publish a new deep dive every week. Don't miss the next one.